Good evening, guys, and welcome. It is the 22nd of October. This is a Futures Trading Performance Pursuit webinar. So straight into it, obviously the focus points for tonight. We can talk a little bit about trade strategy. I'm going to show you the correlated market trade strategy, how to use it, when to use it, and why to use it. We're then going to move on to the price ladder. I'm going to spend a bit of time today discussing how to set up your price ladder, so how to create edge through setting up your price ladder. We'll then talk about obviously the focus points, the Axia trading floor, what the London floor was focusing on this past week, as well as where the energy and attention is going to go to in the week ahead. And then we're going to finish off with my play of the week. Okay, so very briefly, let's go into the trade strategy explained. Now, we're going to talk a little bit about correlated markets tonight. And the first thing, the reason why I want to talk about this is, I had a couple of questions this week. People are asking me, did I think the Bund was a buy because the Dax was selling off on Thursday, or do I think that, for instance, all the Spain, stuff is going to make Bunds go up because obviously the risk-off type flow. So there was a lot of questions around this week, so that's why I want to take the time to explain to you how correlated markets work, how you can add the correlated strategy to your arsenal of trades, but then more importantly also when to use it. I think that's the biggest mistake people make. They assume a correlation exists merely because of what they read in the papers and all that. So I'm going to show you how to determine a correlation if it exists and how to use it. Okay, so some of the basic correlations you get, you will most likely see in risk-off, risk-on type scenarios, when we have major news releases or fundamental releases, as well as when there are flows in the market. Okay, so what you have to understand with regards to a correlation is a correlation is created when one market is being bought and sold, and at the same time another market is being executed in. Okay, now so various reasons can occur as to why the simultaneous buy and sell occurs, but a lot of the time it has to do with hedging. So one of the basic correlations I want to show you is when we have, let's say, a risk off move. So a lot of the time in a traditional risk off, what we'll tend to see is initially we'll see money come out of the equities, so we'll see the equities sell off. At the same time, we'll see those flows going into the bond market. So it's almost like, the investor or the institution that's creating this trade, right? They want to get out of higher risk, equity assets, and they want to get into lower risk or bond assets as a safety measure. Okay, so it's a simultaneous trade that's done, it's executed at the same time, and we tend to see it with equity selling off at the same time, bonds going up. Okay, some of the other types of risk-off type flow you might see is that at the same time we're seeing equities sell off, you might see money go into the low-yielding currencies. So, for instance, the yen, for instance, the Swiss franc. Okay, so that's one of the traditional correlations, and that's why they occur. It's where investors want to still remain. They don't want to be in cash necessarily per se, or they want to be in a different form of asset. So they come out of one asset which is slightly higher risk, and they want to go into an asset that is slightly lower risk. Okay, so now, the most important thing to understand about a correlation is that they don't always exist. In fact, we have not seen traditional risk-off flows for many, many years. Okay, if you get a long-term chart and you date it back to 2005, you're going to see that, whilst equities have rallied for the last, sort of almost 8 years, at the same time we've seen bonds rallying. So we haven't seen a great deal of risk-off, risk-on type flows between bonds and equity. So important when you're assessing a correlation, make sure that it actually exists. And that's what I'm going to show you tonight. So you need to have, and not necessarily a positive correlation, but you need to have a strong correlation. And I'll show you how you can determine those in a minute. Okay. Then note, you always want to trade the correlation. So let's say you've picked up, for example, in this past week, that when we see particularly strong, euro flows to the upside, we tend to see, for instance, the DAX coming off. Now, the reason this correlation exists is very simply the DAX is filled with heavy exporters. Okay, so when we see a very strong euro, we start to see a repricing of potential future earnings. All right, and that creates a rally, or when there's a rally or a strong rally in the euro, we see the corresponding move in the DAX. Now, the important thing to understand is it's not always that if euro is going up, DAX goes down. It's when there are flows in the direction of the correlated market. And again, I'll show you what those flows look like in a minute. Now, some of the key things to pay attention to is when we have a break or a key break of technical areas. In this example, for instance, in the euro, we do then tend to see the correlations occurring in the DAX at the same time. Again, I will show you that in the next chart. Okay, then also just note, one of the important things about the strategy, sometimes a correlation only exists in one direction. Right? And this is another example I'm going to show you in the Bunds versus Spain 10-year. And what that simply means is that two markets can be very highly correlated or a very negative correlation. In other words, a strong correlation exists. However, okay, I can see you asking a question. Save them for the end, Howard, rather. Otherwise, I can't focus on the webinar. So just save the questions for the end. Okay, so make sure sometimes a correlation doesn't exist in both directions, and I'll show you again what that looks like. Right? If you look at the gold, as we're going to, gold and treasury yields this year, there's been a strong correlation both up and down. Right? If you look at the Bund versus Spain this past week, the correlation only exists in one direction. Okay, so the crux of it, guys, don't get too overwhelmed. I'll show you what I mean on the charts, but the crux of it is that only use a correlation if it exists. Okay, that's the key. All right, so let's see how we determine if a correlation exists. Now, as you can see, for all my correlation analysis, I use Metastock Zenith. Okay, for very good reason. I can pick up on the correlations very quickly. I know when a correlation exists. I don't have to think a great deal. Right? So what we can see at the bottom here is a correlation tool. In other words, it shows me a factor of correlation, whether strong or negative, of the two markets I choose. Now, in the example provided, we've got the US 10-year, okay, which is the purple, and at the top we've obviously got the, other way around. Okay, so at the bottom we've got the gold market, and at the top we've got the US 10-year yields. Now, this is a correlation I've been speaking about a lot this year, and the reason I want to use this is because it's a particularly good correlation. All right? What we can see is that since the start of the year, right, no real correlation existed. So within this blue circle, we can see that there was neither a strong nor a weak correlation. Nothing really existed between gold and the US Treasury 10-year yields. Okay? All of a sudden, we start to see a pickup or a drop-off in treasury yields. Right? This was obviously the so-called, Trump trade coming out of the market. And at the same time, when we had a relatively strong correlation, so 0.84, right, we saw that the corresponding move in the gold was relatively strong, whilst US Treasury yields sold off. And we can see that this correlation has existed ever since. So for a good period of 3 months, we had a very strong, in negative, in other words, inverse correlation between the gold market and US Treasury yields. Right? We can see that correlation disappeared for about a month, and ever since then, it's been back on again. Okay, this has been one of the best correlation trades for the year. So some of the things to point out, like I was mentioning beforehand. Okay, let's quickly go over them. So one, we need to identify when there's a strong correlation, not necessarily positive, it can be positive or negative, but a strong correlation. Then we want to see flows or a technical break and determine if it's one or two directional correlation. Okay, so in this example, very quickly you can see that we've got very much two directional correlation. In other words, it doesn't matter whether treasury yields go down or up or down or up, we get a corresponding move in the gold market. Okay, so this is a two-directional correlation. All right, very important because that means you can then trade the gold in both directions off of the US Treasury 10-year yields. Now, the second thing we spoke about is flows. In other words, we want to see directional flows. Now note, we can see when that Trump trade started to come out of the market and yields started to sell off, there was a natural trend. So we saw yields move from 2.6% all the way down to 2.25%. So a real directional flow-driven move. And it's those flows that allow for the corresponding, corresponding correlated moves. Now, when there aren't flows, as we can see in this example, okay, when there aren't flows in the market, that's when we have to be cautious with the correlation. It still exists, okay, but we can't afford to be as aggressive. In these instances, that's when we want to lean on various technical breaks. Again, note the example. So if we see this blue line here, we can see US Treasury yields broke a key daily rising trend line, continue to move lower. At the same time, we got a key technical break, obviously in the gold, and we saw a continuation in the gold price. Okay, so that's what I meant by in terms of flows, number one, as we can see. Number two, the technical break. And then number three, obviously, one or two directional correlations. Okay, so that's the example. Now, before I move on, guys, obviously most of our members know this already, but for those of you who don't know, you know, we do get effectively, you know, Metastocks does provide us for our members a subscription where you pay for 1 month and you get 3 months. So if you are interested in correlated markets, okay, it's not just correlated markets. I mean, we're talking live news, live currency feeds. You know, if you're interested in the product, you know, just trust me, get I mean, you pay for 1 month, you get 3 months to use the product. It's definitely a tool that you've got to have if you're interested in the idea of correlated markets. Okay, so you can follow that link. It is obviously an Axia, you know, what all of our traders use. So if you follow that link, you will be able to get a 3-for-1 special with Metastock Zenith. Okay, now let's talk about the next correlation. Now, again, what I've got in front of you here is, and again, this is all Metastock, but what this is what they call a rebasing tool, and it's wonderful, okay, because what it allows us to do is it allows us to put into perspective what various markets are doing in a given period of time. Okay, so what we can see is the beginning of October. Now, what I've got is I've got all the equity indices, because what I'm trying to see is what this impact of this Catalonia vote is having. Okay, we can read about it in the papers. We can see there's an issue in Spain. They want independence. But what is the ultimate impact across the markets? Where can I identify opportunity knowing what this fundamental is? All right, now, and the reason, guys, I say is because traditionally you go back in the past and you would think, okay, you know, Catalonia vote, you just sell Spanish equities and you buy, you know, German bonds and maybe sell the euro and you'd make money. But if you took that standard approach, as I'll show you in the next couple of slides, you actually didn't make money, okay? And there's reasons for that, and again, I will explain that a little bit later on. But what we can see from this very basic rebasing chart is, note that since the beginning of October, so since the Catalonia issues came to, you know, the fore, we've seen that the IBEX market has effectively seen quite a bit of volatility. So initially, we saw quite a bit of a sell-off in the IBEX early in October, but ever since then, we can see the IBEX is relatively flat. Okay, so in other words, let's say you sold the IBEX. Let's say you thought, okay, the Catalonia vote, it's bad, it's not good for Spain. You sold the IBEX. As you can see, the IBEX has not moved ever since the beginning of October. If anything, it's almost flat since the beginning of the month, right? And that's the key. Now, what we want to do is we want to see in this instance, okay, in this weakness in the IBEX, what has been the resulting impact in, say, the Eurostoxx 50 or the Dax? Okay, so what we can see then, in the same corresponding month of October, we can see that the DAX and the Eurostoxx have been significant underperformers to the US counterparts. Okay, and that would make sense. Why? Because obviously Spain, big regional partner, a lot of big banks, so that's why we can see the Eurostoxx has also underperformed the DAX. So we can see that, you know, Catalonia's vote, or the IBEX, is having a drag on European equities relative to other equity markets. Right? We can see the Dow is up over 3%. We can see the E-minis are up 2.2%. We can see obviously Europe is barely up. Okay, that's the key. So we always want to determine, you know, what does Catalonia bring? In other words, what can we do with knowing that Catalonia is a concern? Right? Had we known this information, had we known there's a strong correlation between, you know, Spain and obviously underperformance in Europe versus the US, we could take advantage of that. Now, let's look at something more interesting, and I want to come back and talk a little bit about the euro. So traditionally, if you go back in the past and you go back to the 2012, 2013, when there were real concerns about you know, Europe and the breakup of Europe, we used to see some significant moves in the euro. So if I said to you, what do you think the euro's done since the Catalonia, you'd probably say you'd think it's down. Right now, if you go to the same time frame, the 2nd of October, we can see that the euro over the course of the month is effectively flat. Okay, it's flat on the month. So that's the thing, you know, traditionally you would have just sold the euro and you would have made money, but that's no longer the game in town. Why? Because the same correlations don't necessarily exist. And that's why we do the correlation analysis, okay? We make sure we know where the correlations are strong so that when Catalonia arises, we can actually take advantage of the opportunity that does exist, not the one that we think exists. Okay, now, what I want to do is I just want to move on and show you another little interesting correlation from last week. So this is what we call a one-way correlation. Now, what we've got in the purple is we've got Spanish 10-year yield, so Spain's 10-year bonds, and in the orange, or in the lower one, we've got obviously German 10-year bonds. So again, traditionally, what we would have normally seen when there was panic in Spanish yields, we would see a corresponding move or an opposite negative move in the bond yields. Why? Because they would effectively sell Spanish bonds at the same time buy German bonds. Okay, now we can see since the beginning of the month, obviously there was a bit of panic. We were at much higher yields. Now, what's happened since, all right? We can see that there was a little bit of higher yields. We would see a lower yield in bonds. So originally or traditionally in the beginning of the month, we were seeing a little bit of sell Spain and buy Germany. However, over the last week, week and a half, all we are seeing, as we can see in the green correlation, is we're only seeing one directional correlations. What that means is that when Spanish bonds rally, in other words, Spanish yields are coming off. Why? Because there's less concern about Catalonia. At the same time, we're seeing the German bond yields, go in the same direction. Okay, so we're only seeing one directional correlation. So what that means going forward, if there is panic with Spain, in other words, if we start to see those Spanish yields rise, why? Because there's concern about a breakup of Spain. We'd be very cautious buying bunds on the back of that. Why? Because the correlation doesn't exist. Right? The newspapers might say it does, but it doesn't. We can see that from the technical correlation charts. Okay, that's why we do the analysis, guys, because sometimes two-way correlations exist, but sometimes only one directional correlations exist. Okay, now let's move on to one of the another interesting chart. Again, someone asked me about this during the week. All right, we saw a bit of risk off on Thursday. We saw a very aggressive 1% down move in the DAX. Now, most people, if I said to them, what do you think the German bond yields did at the same time? They would probably tell me, well, we think they went down. We think the bonds rallied because it was risk off. Now, again, this is where you have to be so cautious, because what we can see is that, yes, we got an aggressive down move in the DAX, but at the same time, note what the German bond yields did. Okay, initially, there was a little bit of a sell-off in yield. In other words, we did see a little bit of a bid in German bonds, but very quickly they reversed that, even though the DAX didn't reverse its move. Okay, that's crucial, because what we saw on Thursday was not risk off correlation flows. Okay, we can see that. Why? Because the DAX didn't recover that entire move. The German bonds closed at the high of the day in terms of yield. Okay, so a risk off correlation does not exist between the DAX or the German DAX and the German bond yields right now. Okay, that can change, of course, but at this present time, we do not have risk off flows between German bonds and the German DAX. Okay, guys, so that's kind of the crux of what correlated flows are all about. Now, since we've spoken about that, okay, a lot of people ask me, how do I set up my ladders? What's the best way to set up my ladders? You know, if the treasury bonds take out the low, should I be selling bunds? That's the purpose of today's price ladder trade strategy. So, again, we're always using trading technologies, as you're well aware. If you do want to get a free trial, by the way, of the trading technologies, you can follow that link. That'll get you a free trial of the trading technologies, and you can set up your ladders like I'm going to show you in a minute. Okay, so what we're going to do is I'm going to show you what market, where, and why. All right, how do you place your ladders around? What should you do with clip settings? What's the purpose of clip settings? Okay, time and sales, when to use, why to use. Size of the ladders, colors. I'm going to show you all these things now, and I'm going to show you why you use them and the advantages. Most important, guys, this is the crux. Listen carefully. Never ever add something that doesn't add value. Right? If you feel that something is a deterrent or something's just creating a noise, don't add it. Okay, so what you've got in front of you is what I'd call my bog standard setup of ladders. All right, this is what I see first thing in the morning, every single morning, and it never changes. Okay, I save this as my default page. All right, so that when I get in the morning, I'm used to seeing it exactly it is. Now, what you'll notice is that it ranges from currencies. Okay, so we've got in the beginning, yeah, we've got obviously the Swiss franc and the Canadian dollar. We've got the Japanese yen, and behind that is the Mexican peso. Okay, so I've got 4 currencies. Now note, you cannot see the Swiss franc or the Mexican peso. Why? Because I don't trade those markets unless they are central bank events. Okay, so instead of me being distracted by maybe one of them moving, I have no interest in seeing those ladders because they're just going to create noise, and that's why I cover them up. However, I still want to know that I have easy access to that ladder, that I can merely just click on the top of that ladder and my Swiss franc will appear. Now, that I would do in the event of, let's say, the Swiss National Bank came out with a comment or they made a decision that was unexpected. Okay, so that's the first. Notice the little bit of an edge there, guys. I'm not covering it up completely. I'm not having a ladder, because in the event that, bang, something unexpected comes out, I can merely click on it and trade. Okay, then notice how I have smaller ladders for the Canadian dollar and the Japanese yen. So straight away, you should be saying, why does he have smaller ladders for these? Very simply, I do not trade these markets outright. Okay, so for the Canadian dollar, I trade if there's central bank events or key economic data. The same for the Japanese yen. Okay, so you can start to see a trend here. I set the ladder up based on the amount of trading I do in it. Then, notice I've got the gold next. Okay, why would I have the gold next? Well, it's very simple. I've got 2 risk-off markets, the Japanese yen, the Swiss franc, and the gold. So I tend to keep these together because in the event of a little bit of risk-off, I will merely make the yen larger, have both gold and yen quite large, so I can see the risk-off flows toward the left side of my screen. Okay, so again then, note guys, there's a very logical reason as to the positioning, the size of every single ladder. That's what ultimately creates the edge. Right? It's all these little bits of information, these very specific design I've got that ultimately accumulate to a trading edge. Okay, the next thing I've got is the oil market. All right, the reason it's there is simply because that's where I want the oil market. Now, I then have my next 2 currencies. I've got the, again, we can see the Australian dollar. The reason that is there is simply because I do trade it occasionally, but it is hidden again. Now, we've got obviously the euro and the pound. Now, these are my 2 most heavily traded, currency pairs. And that's why, as you can see, if this is my entire screen, oh, let me draw this here. Okay, if this is my entire screen, note where they are. Okay, they are center, front and center. In other words, if this is where I do majority of my trading and volume, they need to be in the center of my screen. Okay, now, next to that, you can start to see we've obviously now got FX and commodity on this side. Okay, so that's FX and this is commodity. We then start to move on to the bond market. So what we can see is first the US 10-year. This is the US 5-year. Okay, and above the ZB is the US 30-year. So straight away you can see I've got the entire US bond curve. Why is that? Because I trade the US bonds, I trade the German bonds off of the US bonds, and also I want to know what the curve is doing. In other words, I want to know if the curve is steepening or flattening on any given day. Why? Because in risk-off type moves, we tend to see the bonds flatten. In interest rate types of moves, we tend to see potential steepening. Okay, so I want to know when the curve is doing and what it's doing so that it can add value potentially to some of my trades. All right, I then have the German Bunds. Again, note the distinct layout. Okay, I've got bonds next to bonds. Why? If we start to see aggressive flows or a correlation between German bonds and US bonds, when the flows come into the US bonds, I can lean on them to sell the German bonds. Okay, next to that then I've obviously got the German 30-year as well as the German 5-year. So again, I've got the curve spread. Okay, we then move on to the equities, and again you can see I've got the DAX, German DAX, and the E-mini S&P 500. Okay guys, all in all, I mean you can count there, 1, 2, 3, 4, 5, 6, 7, 8, 9, call it roughly about 12 markets. Okay, I've got 12 tradable markets. Every market I've got limits on are on the front of my screen. All right, that is one type of layout. Now, what I want you to think about, and your homework for tonight, is go and think about how you have your layout and why you have your layout the way you do. Okay, don't just accept that it is like that because that's how I did it first. All right, set it up in such a way that things add value. Now, one of the things I'm going to share with you today is that sometimes I move my ladders around. Okay, and I'm going to show you why. So this is again another type of screen default I have, and this is the wonderful thing with TT is that you can create a number of different default price ladders. So you can merely just you go to a top button here like a start function, and you just open a different layout. Okay, and you can have as many layouts as you want. Now for central banks, I tend to set up very differently. Okay, why? Because, well, guess what? In a UK Bank of England decision, I want to see what is the curve doing? So that's why we've got the UK bond curve with L, and we've got the DEX 17s and DEX 18s. So these are the short stirs markets. I then also want to see the pound. Note where it is, middle of my page. Equally, I want to see the gilts, okay, which is the 10-year. And then obviously I want to see some short-term charts. Okay, so important. This is what my layout would look like for a Bank of England rate decision. Okay. Again, what I want to do is obviously I know there's a strong correlation between cable and the gilts. I know equally if the interest rate markets start to move, they can provide certain information. So I put the ladders based on the information I want from them. Right, that's the key, guys. That's why we move around our ladders, and that's why it's so important that you create different types of layouts using your trading technologies. Okay, don't forget you can obviously get a trial for this, a free trial, and give it a go and play with yourself. Okay, now some of the other things that I tend to pay attention to. Right, what you can see is I've got time and sales on certain markets, but not all markets. All right, I've also got profiles on some ladders, but not all ladders. All right, it's very simple. The markets that I trade outright, day to day, technical breaks, fundamentals, trade all day, every day. Those markets I will always have some form of a profile. Okay. Then the markets where I feel that I want to see where heavy flows come in, I will always have a time and sales, and that's this on the right hand, the German Bund. And we can see all the time and sales it's a summary or a snapshot of the volume that has been going through over a given period of time. Right? Equally, note the highlights I've got. Okay, so whenever there's a lot of flow coming to the German Bunds, you'll see it gets very, very colorful, and we start to see a lot of blue and a lot of red, which indicates big volume, big clips coming into the market. Right? Again, with the TT, you can obviously set up a default setting. In other words, show me only when X amount of clips come in. So very, very handy tool. But note, guys, don't just add a time and sales for the sake of adding it. Add it because it adds potential value. That's the key to this entire Periscope, right? You're listening to me because you feel I can add some value to you. Equally, don't just put things in front of your screen because you feel it adds value. Only add things that will ultimately give you a better decision, right? That's the key to it. Okay. Now, the last thing I want to discuss with you is the clips. And this is again where TT is very, very wonderful, and what you can see, okay, in this top left box here, we're going to use the German Bund as an example, all right? We've got obviously a 10 there, and then we've got a 10 at the bottom. Now, what's wonderful with the TT is you can actually create multiple clicks. In other words, if I went into this German Bund right now and I left click, I would be buying 10 contracts at the market. However, if I went in and I right clicked, I would be buying 50 bunds at market. Okay, now this is crucially important to a trade, and again it's an edge of a trade, and the reason why we have multiple clicks is simple. When fast money comes out, or fast moving information, right, every single price matters. In other words, if I go and click with a 10 and I have to click 5 times, or I can just click once with a right click, right, the difference could be 4 or 5 prices. Now 4 or 5 prices with an extra 40 contracts effectively is 1,600 euros difference. Okay, so you can see how just having the right click can make me 1,600 euros more. And that's the key, guys. It's not that day traders are special or smart or anything. It's just that we know what tools to use. We know how to create little edges, and all those little edges start to add up to quite a lot of edge. Okay, so that's what the clicks mean. I can use multiple clicks and ultimately, navigate my way around effectively. Okay. Alright guys, that's the price ladder. Let's then move back and talk about some of the key features from the past week. Now, some of the things we focused on last week, obviously UK CPI earnings and retail sales were crucially important. Why? Because the Central Bank of England currently has a 7-2 stance in favour of no rate hikes. Okay, so we needed to see, obviously the central bank has told us they'll only need to see relatively little more information to determine whether or not a rate hike is coming as soon as November. Now, in terms of what came out, CPI came out at 3%, okay, the highest it's been in years. Earnings was a 0.1 beat to the upside, so a good number. And obviously retail sales was a miss. Now, remember, the Bank of England is hiking because inflation is exceeding their target. So again, net and net, for all intents and purposes, the Bank of England should be set to hike rates in early November. Okay. The next piece of information we were focusing on was the New Zealand election result. Obviously, Labour was the partner that was picked. And we've seen quite an aggressive sell-off in the New Zealand dollar. There was quite a lot of focus on that market earlier this week as it created some opportunities. And then obviously we've been really closely watching, what's going on between Theresa May and EU's Barnier. The net crux of it, effectively, the UK is saying, well, they're willing to pay 20 billion. Effectively, Macron is saying, at least 40 or more, with the general stance being 60 billion. Okay, so what we can see is that, there's a real tough negotiating stance going on. They're going to probably end up somewhere in the middle and come to some form of an agreement. But right now, there's just a lot of talk that the UK wants to go further that way, sort of hoping the EU won't call their bluff, where the EU is standing pretty pat and not really shifting on, talking about anything other than the current divorce bill. Okay, so keep an eye on that. It's still very much a focus point in the week ahead. Okay, now this is key. This is a really big week this week. I cannot express how big this week is for traders. It's very simple. It comes down to that. It's all about the ECB. What I would say to you on a scale of 1 to 10, this could be one of the biggest weeks for day traders, for swing traders. But it's all about the devil's in the detail with regards to what the ECB tells us. Okay, so we're heavily focused on ECB come Thursday. Note, obviously, we've also got the Bank of Canada this week, as well as, again, very key economic data being the UK GDP and US GDP. It's the first read of Q3. Something else the traders are paying attention to, obviously Mr. Trump has told us that he will tell us his candidate choice for the Fed before he leaves for his trip on the 3rd of November. So highly likely, very high potential that we get an announcement this week of the candidate chosen. Markets still seem to think Powell is the front and center choice. However, he had a good meeting with Yellen. He's had a good meeting with Taylor. Walsh was once upon a time the key candidate. And Cohn, obviously, whilst being ruled out, is still, the ideal candidate based on what Trump wants. Very friendly to markets, wants to get rid of regulation, etc., etc. So again, any one of these 5 candidates is still the potential. So just make sure you know what you're going to do in each scenario. Okay. What I would say then, obviously, we're also just paying attention to any Catalonia spillover. We will be watching the Spanish 10-year and IBEX early on tomorrow morning, so keep an eye on that. And then my favorite one, Apple. Okay, I think Apple could be a fantastic earnings to pay attention to. I think it's out Thursday night. Reason being and why it's so important is we've really seen some negative news coming from Apple with regards to obviously the sales of the iPhone 8 as well as delayed orders of the iPhone X. So remember, it's not necessarily about what has been, but it's all about guidance. Okay, so pay attention to the guidance Apple gives us after the close on Thursday and listening carefully when they tell us what their expectation for earnings is going forward. Okay. My play of last week, it's very simple. We spoke about the GBP and we spoke about the inside week. And my play of the week was very simple. We were talking about in the event of a beat on inflation. So it was expected 3%. In the event of a beat, we were playing for a break to the upside. Now, we didn't get a beat. It came in exactly as expected. So the play was never initiated. Now, what we did speak about was targeting that 134.45. We spoke about it being a really key little resistance area, and then I felt it needed to be retested. In other words, it just felt that the cable wanted to take that area out and then maybe pop lower. So again, my play of this week, it's very simple. It is again the pound against the dollar. What we're looking for this week now is a break of last week's high to initiate longs toward the 134.45. Okay, what I do want to, and why this is my play of the week, it's very simple, okay? Have a look at this candle formation, and what you'll see is that on Monday, we opened at the high and closed quite weak. On Tuesday, we opened where we closed. We tried to bid, but again, we closed quite weak. On Wednesday, we opened where we closed, and we posted a very marginal up day, but still relatively weak given what we did Monday, Tuesday. Thursday, we opened where we closed, and we sold off and closed weak again. So we almost had a series of 4 sell-off days where we had a series of lower highs and lower lows. All right? Then on Friday, note what? We got the break, so we saw a little bit of aggression. But for the first time, we actually saw a relatively strong close. So in a series of 5 days, we finally got a relatively strong close. Now, that in its own does not imply a buy. Okay, that's not enough of a reason to buy for me. What will be enough of a reason is if we get above Friday's high, but we close above Friday's high. That's the key. I want to see a close on the dailies above Friday's high to then initiate longs for the break of last week's high and the extension up to 134.50s. Okay, note the risk reward. Obviously, a close above would be around 132. We're targeting a 250 tick target. Okay. So that's it, obviously. That is our scoreboard. As we can see, we've still got our US 5-year Treasury notes. We've still got our other half of our Apple trade from almost 3-4 weeks ago. And we're ultimately now looking for a long above the 132s once we get the close. Okay, guys, let's take some questions. What I'm going to do whilst I wait for your questions, I'm just going to go back and give you those links again for both the free trial of TT as well as the 3-for-1 trial of the Reuters icon. So there it is. If you do have any questions or you do, not sure about this trial, you can email info@Axia Futures. They will forward you this trial, and you can try the TT trial out. Again, guys, it's free. Give it a go. If price ladders add value, if they add edge, don't shoot yourself in the foot. Right? If every professional trader is using a price ladder, there's a good reason for it. Okay, so that's the link there, and then just for the Reuters icon, we can just quickly go back up there. There's the Metastock Reuters Zenith, and you can see it's just www.metastock.com/Axia341. Okay, guys, let's get those questions in and see if I can answer your questions. And what I'd like to say, rather than make them market-related questions, let's try and make them about the price ladder setup or how we set up the ladders. Whilst I wait for those questions, as I always say, okay, you can't motivate people. You can only create a context in which people are motivated. All right? Do you clear volume for etc. etc.? So do I clear volume? I'm guessing you're asking, when I have a price ladder, do I remove the volume from, for certain data? Okay. Yes. So to answer your question with the central banks, I do. I have a ladder set up for every central bank. Okay. Equally, for for key times of the day, I might want to shift between US markets and European markets. Okay. So just play with it. Create as many templates as you want. Okay. So do I clear volume? I don't clear volume. Right. The reason being is that I like to see how the profile develops over the course of the day. So I don't clear my volume, but again, that's a personal preference. If you feel you want to clear your volume because it adds value, then that's fine. Okay, there's no right and wrong in this situation. So yeah, I hope that answers your question. Okay, again, just with regards to obviously some of the things this week, look for the correlations. We can see bond yields are rising, so look how the bonds respond. Do you always have bubble shats, books, or ladders up while trading bunds? 100%. Okay, if I'm a bund trader, but again, note what I'm going to say here. I will only utilize the shats and the bubble in the event that there are flows. In other words, if I see something coming into the front end, let's say I see, suddenly the shats does on a daily average or an hourly average does 10,000 contracts, and suddenly I see someone smashing 30, 40,000 contracts in the shats. By 100%, I'm going to be trading the bunds off that. Why? Because there is flow, there's directional flows, okay, and there's potential for the break of key technical areas, right? So only when that correlation exists will I trade the bunds off it. Okay, it's not a case of if Schatz is taking out the low, you sell the bund. Okay, that's hocus pocus, right? That's balderdash. That isn't edge. That's just a gamble. Okay, so just make sure you're utilizing those ladders for the right reasons, right? Okay guys, let's wrap it up there. Like I said, you've got those links. Have a look at those links. If you have any questions, info@axiafutures.com. Remember, I'm not here to motivate you. I'm here to create the opportunity for you to be motivated. Okay, I've given you the context. I've shown you the ladders. I've shown you how to develop your own edge. It's up to you to go and develop it. Okay, otherwise it falls on deaf ears. It's your job now to go and develop your own edge through the ladders. Right, good luck for the week ahead, and I'll catch up with you guys again next week.